Welcome back to Good Revenue. Today we're going to talk about credit downgrades, trade crime, AI reality checks, and the espionage economy. So thanks for joining us. And if you haven't already, subscribe to the feed. As always, you can find links to everything we discuss in the show notes. Thank you for joining us. First up, bad debt is everywhere. By now, you might have heard that Moody's has just downgraded U.S. credit. So the U.S. went from AAA ratings to AA-1. And it's historic because this hasn't happened since 1917. If you're not a big history buff, that would be in the middle of World War I. So it's a really big deal that all three credit rating agencies no longer believe that the United States has perfect credit. What you might not know is that this appears to be a systemic challenge. So prior to 2009, 60% of sovereign debt globally was AAA rated. Today, that number is at just 8%, according to Moody's. The largest at-risk borrowers are actually B- rated, and they range from countries like Brazil, Argentina, Turkey, and Egypt. The challenge overall is that a lot of countries have some similarity to the United States, but we are in a particularly tough position here in the US. Our national debt is already accruing interest costs of almost $1 trillion a year, $950 billion specifically in fiscal 2025, and as much as $1.8 trillion by 2035. Not great. In addition, the IMF is warning that in a severe scenario, global public debt could exceed 117% of GDP as early as 2027. Those are levels we haven't seen since World War II. So this isn't just about spreadsheets and the bond market or meme coins. This is about the foundation of the global financial system, which appears to be under serious strain. Speaking of structural problems, let's talk a little bit about trade policy and how it's leading to white-collar crime. Next up, why have stable, predictable trade policy when you can just have daily chaos? That seems to be the current attitude to global trade. Just when you thought the tariff tax drama had stabilized, the president and the EU started fighting again about the pace of negotiations between the two stakeholders, with huge effects again on the economy and particularly the stock market here in the United States. Here's the latest. 50% tariffs on the EU imposed by the United States have been postponed once again until July 9th. The US is demanding major concessions from the EU, changes to tax rules, removal of digital services taxes, and the EU wants 0 for 0 tariffs on things like industrial goods, steel, aluminum, and they want taxes removed from car imports. So these are pretty complicated issues that seem unlikely to be resolved easily. There's been some really interesting data about tourism that seems to parallel all the drama going on the trade and tariff front. New data from Trivago shows bookings from countries like Japan, Canada, and Mexico have declined by double digits. Those names may be familiar because those are some of the countries with which the United States has been the most aggressive in terms of tariffs. And they are also among the largest trading partners for the United States. So tons of complexity there. This seems to echo some of the data we sourced last month from ITA, which noted that travel to the United States from both the EU and Asia has declined significantly in the past year. The third story is the New York Times is reporting that trade-related crimes are actually on the rise under this new complicated tariff regime. The result is that companies are mislabeling goods, they're underreporting values, and they're rerouting shipments through third countries. Even businesses that are trying to comply can't necessarily figure out what the rules are on any given day. Federal authorities are trying to ramp up enforcement, but new firms are actually popping up more quickly than enforcement could actually keep up, specifically to help importers evade tariff taxes. The problem here is that this economic policy is creating its own criminal ecosystem, it seems. When compliance becomes a moving target, you're incentivizing evasion. Based on the reporting, this just seems like a huge economic mess being created by the confusion in tariffs And even for the companies that want to do the right thing, it's just not clear necessarily how to do that. Next up, another AI reality check. After 2 years of AI hype, there's some cold reality coming in from the University of Chicago. A massive study was just released. It tracked 25,000 workers across 7,000 firms in Denmark over the span of 2 years. And the results were that statistically, there's a zero impact on wages, working hours, or employment. Despite widespread corporate AI investments and training programs, the economic effects are, in the researchers' words, statistically indistinguishable from zero. Workers are reporting modest productivity gains, about 3% time savings, according to this study, but that hasn't translated into meaningful economic changes. Meanwhile, over in DC, the US Copyright Office just released a framework for AI that got its registrar fired the day after publication. And it's actually odd because it's a pretty neutral document, but the portion that no doubt got the attention of AI advocates and firms is the fact that the framework very clearly indicates that most AI ingestion of copyrighted material very likely violates the fair use doctrine, which is a core principle of copyright law. And we've talked about some of this in a prior episode. But this framework is really interesting because it seems that AI firms want it both ways. They want to be able to ingest and freely train models on copyrighted materials, but at the same time, they object to competitors training off of their models. AI is not just being debated in the Copyright Office. Congress is also getting into the mix in its wayward way. While AI struggles to deliver promised economic transformations, the House-passed reconciliation bill just included a 10-year moratorium on AI regulation at both the state and local level. This prevents states from regulating AI, and 49 out of 50 state AGs are really unhappy about it. We'll see what the Senate actually does. But even if you love AI and you don't think it should be regulated, it might be worth taking a look at the language because it specifically talks about automated decision making, which has incredibly broad application, everything from healthcare to energy, financial services, transportation. Think about all of that being embargoed from any regulation for a decade. I'm going to assume there are some unintended consequences that we're probably not going to be thrilled with at the end of that time. So we'll see what happens with this one. The disconnect between AI hype and reality is becoming even more dangerous when you look at national security issues. Okay, our last segment. This is the espionage economy, and boy, do we have some wild stories for you here. First of all, the Treasury Department is reviewing Benchmark Capital's $75 million investment in a company called Manus AI. It's a startup with roots in China. The scrutiny from the administration is coming from a 2023 law, which requires entities to notify the Treasury Department about their investment in key sectors and in countries of concern, most notably China. The law is designed to prevent U.S. capital from helping to advance technologies that could threaten U.S. national security. Semaphore reported on this, and they also flagged up another wild story from the Stanford Review. The Stanford Review recently investigated sophisticated Chinese espionage operations on campus. Agents impersonating students are targeting researchers in sensitive fields, while actual Chinese students face serious pressure from the CCP to submit situation reports about their research and campus activities. So this isn't just about one deal. There's a wider question about IP theft and technology transfer. Our final story is from the Financial Times. The US BIS, that's an agency within the Commerce Department, has ordered US chip design software firms to stop selling in China, suspending existing licenses and potentially instituting new licensing requirements. This latest story marks a significant escalation in the rivalry between the United States and China when it comes to tech, particularly semiconductors. So stay tuned. As you can see from these stories, this isn't just about one deal or one company or one investor. It's a bigger conversation about U.S. capital, science, research, and intellectual property, whether it's flowing to competitors or to adversaries or to allies. It's also really tough timing because the federal government has been cutting all sorts of R&D funding and also has been fighting with US universities, threatening those universities with additional cuts to R&D and science funding. There's a really interesting article written by Steve Blank, which appeared in Nature this month, and it's also worth taking a look at. He really breaks down the history of scientific research in the US post-World War II and why it was so successful in building the most successful companies that the world has ever seen, almost all of which were built here in the United States. And so it's an interesting question that at the same time that we're trying to aggressively protect US IP, what are we doing about science and research and the next generation of ideas and innovation that would power our economy as well as the global economy? It's not just about competing economically today. There are some serious questions about the US research infrastructure and what we need as a country and as a world to meet emerging challenges and threats. As always, thank you for joining us, and we'll see you here soon.
Thanks for listening. If you liked what you heard, leave us a review, subscribe to the show, or check out another episode. We appreciate your support.